All right, fundamentals of investing, kids. This is the week of May 4th through the 8th. We're going to talk about options this week. Probably the most difficult material that we've talked about so far this year. It's split into 2 weeks. This week we're going to talk about call options. Next week we're going to talk about put options. So once again, you're going to have this video, the notes, the assignment, and the test. Getting right into the notes. All right, so what is an option? Well, first let's talk about what is a derivative. A derivative is an asset or a investment that is dependent upon the price of something else. So if we're going to talk about options, call options on Ford, then the underlying stock or the underlying asset is going to be shares of stock in Ford. So the call option on Ford is going to be dependent on how much Ford stock is trading for at any given time. I know this seems confusing, but it's going to make more sense when we get through an example. So options are contracts that grant the right but not the obligation, meaning you don't have to do it. You have the right to, but you don't have to buy or sell an underlying asset at a set price on or before an expiration date. We're not going to talk about put options this week. So the right to buy the underlying stock is what's called a call option. If you buy a call option in Ford stock, then you get to buy Ford stock at a certain price before a certain expiration date in the future. All right? Once again, it's going to make a lot more sense when we get into an example. But I want to get some definitions down first. So, why is my scroll bar now? All right, here we go. So, call options. Once again, a more exact definition. A call option might be thought of as a deposit for a future purpose. By buying a call option, the buyer is paying a premium. You're paying money now to have the right to buy shares of stock in a specific company at a specified price by a certain time in the future. All right? So let's look at each one of those parts individually. To summarize, if you buy a call option, you are paying money. It's called premium. You're paying a premium to have the right to buy a specific asset, which are shares of stock in a company, at a specific price called the strike price between now and a specific date called the expiration date in the future. One call option gives you, the owner, the right to buy 100 shares of the underlying stock. Once again, this might not make a lot of sense until we get into an example, but we're going to. Well, here is the example that I promised I would have. All right, so assume today is May 4th, which it is, and shares of Exxon are trading at $81 a share. All right, the call symbol for Exxon is XOM. All right, so it's May 4th, and stock in Exxon's trading at $81 a share on the market. So you could go in and buy or sell Exxon at $81 right now. So assume that you buy one ZOM, meaning Exxon, August 14th, 85 call option at $2. All right? That might not mean much to you right now, but it's going to as we go through each part. So let's identify each part of this call option. So first, you are paying premium. You're paying money. In this case, $2. That ended the sentence at $2. So you're paying it $2 for this call option. All right. 2, to have the right to buy a specific asset, which in this case is shares of stock in a company. The company is Exxon. So you have the right to buy 100 shares of stock in Exxon at the specified price, which is the strike price. In this example, the strike price is $85. All right. And I'm sure you probably already figured out the expiration date is going to be August 14th. So if you go back up to the example, you bought one Exxon August 14th, that's the expiration date. After August 14th, there is this asset, this option expires. It's not worth anything anymore. The strike price, you have the right to buy Exxon stock at $85 a share, and you're paying $2 for this right. All right? Now, since you're having the right to buy 100 shares of the stock, you're not actually buying $2. It's not going to cost you $2. It's actually going to cost you $200 to buy this option. All right? Because once again, remember, you have the right to buy 100 shares of Exxon stock at the price of $85. And that's going to cost you $2, but you have to multiply that $2 by 100 shares, so it's going to cost you $200. So you're going to spend $200 for the right to buy 100 shares of Exxon stock at $85 a share between now and August 14th. So let's do another example before we get into what happens once the stock starts to move. So assume that General Motors is trading at $29 a share, and you buy one GM September 20th 30 call option, and you paid $1 premium. Once again, let's go through each of the parts. The premium you're paying is $1 times 100 shares, or $100. So it's going to cost you $100 to buy this call option. The specified asset is going to be shares of stock in General Motors. The strike price is $30 a share, so you have the right to buy GM at $30 a share. And the expiration date is September 20th, 2020. So you have to do this between now and September 20th. All right, and once again, I already stated that you have the right to buy 100 shares of GM stock. All right, so to restate this a little differently, what you have received for the $100 that you paid in premium is you've received the right to buy 100 shares of stock in General Motors at the price of $30 per share between now and September 20th. All right, at this point, you should understand the four major parts of a call option. The premium is the money you're paying for the right to then buy the stock at a certain price in the future. All right, so that's the amount of money it's costing you to buy this call option. The specific asset is the underlying shares of stock in whatever option you're buying, whatever call option you're buying. In this case, we just bought a General Motors call option. All right, the strike price, that's the price that you have the right to buy it at. In the last example, GM, we said it was $30 a share. You have the right to buy it at $30 a share. And the expiration date is the date that your right to buy the 100 shares expires. So after that date, you can no longer trade this call option. All right, so one last example real quick. Assume today is May 4th. Home Depot shares of stock are trading at $88 a share. That means you could buy Home Depot stock at $88 a share right now if you wanted to in the marketplace. You bought one, this is your example. You bought one Home Depot July 24th 90 call option and you paid $2 in premium. So once again, the premium you paid is $200. It's the $2 you paid times the 100 shares that you have the right to buy. The specific asset in this case is Home Depot shares of stock. The strike price is $90 a share and the expiration date is July 24th. All right. So very important concept to understand, and this is going to make a lot of sense at this point. It should. When you buy a call option, you hope the price of the stock in the company goes higher. Why? If you have the right to buy Home Depot stock at $90 a share and the stock goes, it's trading at $88 a share right now. But if it goes up to $100 next week, look what you could do. Remember, you bought the call option and it gave you the right to buy 100 shares of Home Depot at $90 a share. So if Home Depot shares go up to $100 a share next week, you can exercise your call option and pay $90 a share for each of those 100 shares, and then immediately sell those shares of stock for $100 each in the stock exchange, on the stock market. All right? So if that was to happen, you'd make money. Let's go through the example. I think I go through it exact here. So what might happen if you buy the Home Depot call option? Well, there are a number of reasons you might choose to buy $200 worth of call option instead of buying 100 shares of Home Depot stock at $88 a share. Right? So the first question is, you might ask yourself, why would you pay the premium of $200 when you to have the right to buy it at $90 a share when you could buy shares of stock at $88 right now, right? That doesn't make much sense. You can buy them for $88 a share now in the marketplace. Why would you pay someone $200 to have the right to buy them at $90 a share? Well, you might think the shares of Home Depot stock will go up. If Home Depot stock shares go up to $100 per share, like we did in the prior example, right? If they go up to $100 a share before the expiration date of July 24th, then your call option is worth at least $10. Why? Because you can exercise your call option and buy the 100 shares of stock at $90 a share, and then immediately turn around and sell those 100 shares at $100 on the stock exchange. This means you make $10 on each one of those shares of stock that you bought, right? You paid $90 because you had the right to pay $90, and then you turned around and sold them at $100. So you made $10 a piece on 100 shares. That's $1,000. However, you didn't actually make $1,000 because you had to pay $200 in premium to have the right to do that. So you'd make $1,000 by buying it at 90 and selling it at 100, which is $1,000, but then you have to subtract the $200 that you paid for the premium in the first place. All right, so you make $800 off that example. All right, the second reason is that you would buy this call option. Think about it. Let's assume that you buy 100 shares of stock in Home Depot at $88 a share instead of buying the call options, right? Instead of buying the right to buy it at $90 a share, you buy the shares of stock at $88. Well, Home Depot could really have some bad news, such as a huge lawsuit that was filed against them that could cause them huge amounts of losses. So this is bad news, and it could cause the stock price to fall to say $76 a share. This means, or if this happens, you would lose $1,200. Remember, you bought 100 shares at $88, costing you $8,800. And now those 100 shares are only worth $7,600 since the stock is trading at $76 after the bad news. So you lost $1,200. If you had bought the call option instead for $200 and the stock falls by a whole bunch, you do nothing. You just let the call option expire and you lose the $200 in premium that you paid. Remember, you have the right, but not the obligation. You don't have to buy the shares of stock at $90 a share, right? So if the stock price goes from 88 to 76, you're not going to want to buy them at $90 a share. So you're just going to let the option expire worthless, meaning you lose your $200 and that's it. It's all over. You lose $200. You don't lose the $1,200 because the stock fell by 12 points. So as we can see, you can make money when the stock goes up if you buy the call option, and you can also save a lot of money if you buy the call option instead of buying the stock, because if the stock goes way down, you only lose the premium if you buy the call option, but you lose a lot more if you buy the stock itself. Okay? All right. I don't want to do any more this week. We're going to talk about put options and some other things about options next week. Try to do the worksheet. If you have no problems with the worksheet, then take the test. If you have problems with the worksheet, email me. And if I have at least 2 people that email me, we'll have a live Zoom meeting on Thursday of this week. All right? All right. I hope everyone's healthy for the next, forever. I hope you and your family are very healthy. All right? I'll talk to you soon again. Bye.